There is a moment, usually very quiet, when a system stops behaving the way everyone expects it to. Not with panic, not with sirens, but with a single number that suddenly refuses to make sense. Silver was never supposed to do this. For decades, it was dismissed as background noise, a relic, a hedge that never quite hedged, a commodity too boring for the modern age of algorithms and artificial intelligence. Analysts called it dead money. Institutions treated it as irrelevant. Retail investors forgot about it entirely. And then, almost without warning, the price stopped listening. Not drifting, not climbing gradually, breaking. This is not a story about a speculative bubble. This is not a story about traders losing discipline. This is a story about limits. And limits are the one thing modern markets are least prepared to face. Because for more than 40 years, we've lived inside an economic environment built on a single, comforting assumption: that every problem can be managed. If demand weakens, inject liquidity. If markets fall, stabilize confidence. If costs rise, subsidize or regulate. The belief isn't that mistakes won't happen. It's that no mistake is final. Silver challenges that belief at its core, because silver is not a financial construct. It is not a digital abstraction. It is not a narrative. It is a physical input embedded deep inside the machinery of modern life. And when physical inputs become scarce, no amount of monetary creativity can replace them. Now here's the uncomfortable truth. This price movement is not the event. It's the signal. A signal that something far larger and far more structural has already shifted beneath the surface. If you understand what silver actually does inside the US economy, you'll begin to see why this moment is different from every commodity rally before it. Silver is not just an investment asset. It is a critical dependency. Every solar panel relies on it. Every electric vehicle requires it. Every advanced semiconductor, data center, military system, medical device, and communications network uses it. Not symbolically, not optionally, physically. Silver is the most electrically conductive metal known to science. Nothing moves electrons more efficiently. Nothing dissipates heat more reliably at scale. There is no perfect substitute. Copper can replace it with efficiency losses. Aluminum can replace it with reliability trade-offs. Gold can replace it at a cost that destroys margins. In competitive manufacturing environments, these trade-offs are fatal. For years, companies assumed silver would always be there, cheap, available, invisible. They built trillion-dollar valuations on that assumption. Now that assumption is collapsing, and the consequences will not be evenly distributed. This is where the real story begins. Because when an input that underpins modern technology becomes scarce, the effects do not move linearly. They cascade. Margins compress, contracts break, valuations unwind, and markets that were priced for perfection suddenly have to price for constraint. This is why silver matters more than gold right now. Gold reflects trust. Silver reflects function. And function is where systems break first. To understand why this moment is so dangerous for US equities, you need to understand silver's dual nature and why it creates a trap that policy cannot easily escape. Silver is both a monetary metal and an industrial one. For 5,000 years, civilizations treated it as money. Empires rose and fell with silver flows. The Roman denarius collapsed when silver content was debased. The Spanish Empire flooded Europe with New World silver and triggered inflation that reshaped global trade. Money tied to metal imposed discipline. You couldn't create more without extracting it from the earth. That discipline disappeared in the 20th century. Currencies became elastic. Debt became permanent. Growth became assumed. But silver never stopped being physical. While money became abstract, silver remained bound by geology. And geology does not negotiate. Here is the constraint the market ignored for too long. Over 80% of global silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This means silver supply does not respond to silver prices. You cannot simply mine more silver because prices rise. If copper demand slows, silver supply slows with it, regardless of silver prices. This makes silver fundamentally different from oil, agriculture, or most industrial commodities. Price signals don't bring supply online. They only ration demand. Now combine that with the demand side. Industrial silver consumption has exploded over the past 2 decades. Solar energy alone consumes hundreds of millions of ounces annually. Electric vehicles add tens of millions more. Data infrastructure, defense systems, medical technologies, and electronics consume silver relentlessly, often in quantities too small per unit to recycle efficiently. Once silver enters a product, much of it is gone. Landfills don't return it. Recycling recovers fragments at best. So demand compounds, while supply stagnates. For years, the gap was masked. Governments sold reserves. Warehouses drained inventories. Paper markets smoothed volatility. But buffers don't regenerate themselves. And now, those buffers are nearly empty. This is why the move in silver didn't unfold politely. When markets realize scarcity is real, not theoretical, repricing happens violently. Because price is the only remaining balancing mechanism. Now, here's where this stops being a commodity story and becomes a systemic one. Modern US equity markets are priced on growth assumptions that silently rely on cheap, abundant inputs. High price-to-earnings ratios assume expanding margins. Expanding margins assume stable costs. Stable costs assume abundant materials. Silver breaks that chain. And when the chain breaks, valuations don't adjust slowly. They snap. The most vulnerable sectors are not speculative fringe industries. They are the core of the modern economy. Technology, renewable energy, advanced manufacturing, defense. The very sectors policymakers rely on for future growth. This creates a policy paradox. The US government can influence financial conditions. It can guide interest rates. It can inject liquidity. But it cannot manufacture silver. It cannot print conductivity. It cannot legislate atoms into existence. This is the boundary where monetary power ends, and markets are starting to sense it. That's why this moment feels different. Not dramatic, unsettling. Because beneath the price chart is a deeper realization. Some problems are not solvable with money. They are solvable only with time. And time is exactly what highly leveraged systems don't have. This is the warming phase, the part where investors tell themselves it's temporary, that supply will respond, that technology will substitute. But physics doesn't respond to reassurance, and substitution takes years, not quarters. In the next part, we will examine how this silver shock propagates through US stock markets in precise, mechanical ways, why high-growth equities are uniquely exposed, how margin compression turns into valuation collapse, and why this dynamic mirrors historic crises that policymakers failed to control. Because once you see the mechanics, the outcome stops looking random and starts looking inevitable. When markets encounter a constraint they cannot arbitrage away, behavior changes first, and narratives follow later. This is exactly what is happening now. At first, the response is denial. Commentators look for familiar explanations. Speculators are blamed. Temporary disruptions are cited. Charts are smoothed. Models are adjusted. But beneath these surface explanations, something far more mechanical is unfolding. Silver is not rising because demand is hot. It is rising because supply is inelastic, and inelasticity is poison for a system built on leverage. To understand why this matters so deeply for US equities, you need to understand how modern valuations are constructed. Most high-growth companies are not priced on what they earn today. They are priced on what they are expected to earn tomorrow. Discounted cash flow models dominate Wall Street thinking. Future profits are projected decades forward. Small changes in assumptions create enormous swings in valuation. These models quietly assume one thing above all else: that inputs remain available at predictable costs. Silver breaks that assumption, not gradually, discontinuously. When an essential input becomes scarce, costs do not rise linearly. They jump. Contracts are renegotiated. Production schedules are delayed. Margins compress suddenly. This is not inflation in the consumer sense. This is margin destruction. And margin destruction hits valuation at the root. A company with shrinking margins is not simply less profitable. It is less predictable. And unpredictability is lethal to growth multiples. This is why silver's impact concentrates in specific sectors. Semiconductors rely on silver for advanced packaging, bonding, and conductivity layers. These are not optional components. They are embedded deep in manufacturing processes, refined over decades. Renewable energy relies on silver paste for photovoltaic cells. Reducing silver content degrades efficiency, which undermines the economics of deployment at scale. Electric vehicles rely on silver across power electronics, battery management systems, and charging infrastructure. Cost increases ripple through already thin margins. Defense and aerospace rely on silver for reliability under extreme conditions. Substitution is not merely expensive, it introduces unacceptable failure risk. These industries do not simply pass on higher costs. They absorb them until they can't. And when they can't, investment slows. This is the second-order effect markets often miss. Rising input costs do not only reduce profits, they delay decisions. Capital expenditures are postponed, Expansion plans are revised, hiring slows, growth assumptions quietly break. And when growth assumptions break, equity markets reprice brutally. This is why silver does not need to become unaffordable to matter. It only needs to become uncertain. Uncertainty forces conservatism, and conservatism kills momentum-driven markets. Now consider the timing. The US economy is already carrying historic levels of debt, public and private. Corporations refinanced aggressively during years of near-zero rates. Governments expanded fiscal commitments. Consumers normalized leverage. This structure works only if growth remains smooth. Volatility breaks the illusion. When input scarcity collides with leverage, fragility becomes visible. This is not theoretical. History offers clear parallels. In the 1970s, energy constraints collided with monetary expansion. Oil was not just a commodity, it was an input embedded in everything. When oil prices surged, the entire economic structure adjusted painfully. Inflation accelerated, margins collapsed, equities stagnated for a decade. Policy responses lagged reality. Today, silver occupies a similar structural position, but inside technology rather than transportation. The difference is speed. Modern supply chains are optimized for efficiency, not resilience. Inventory buffers are thin. Just-in-time logistics dominate. Redundancy is considered wasteful. This makes the system extremely sensitive to disruptions in key inputs. When silver inventories drain, there is no slack. Prices don't drift, they gap. And gaps expose balance sheets. Now here is where the policy dimension becomes unavoidable. The US government can subsidize industries. It can issue credits. It can pass legislation. But it cannot shortcut geology. If silver is scarce, subsidies simply reallocate scarcity. They don't eliminate it. Worse, subsidies often increase demand, intensifying the shortage. This creates a policy feedback loop. Support accelerates deployment. Deployment increases silver consumption. Consumption tightens supply. Prices rise further. At that point, policymakers face a dilemma with no elegant solution. Restrict growth and admit limits, or accelerate intervention and deepen imbalance. Neither option is politically comfortable. Markets sense this hesitation. That is why silver's price action feels destabilizing rather than celebratory. It is not a bet on prosperity. It is a referendum on constraint. Now look at how equity markets respond to constraint historically. They rotate. Capital moves away from long-duration assets, those whose value depends on distant future cash flows, and toward near-term, tangible value. This rotation is not ideological. It is mathematical. Higher uncertainty increases discount rates. Higher discount rates crush long-duration valuations. Technology stocks, growth equities, and speculative innovation suffer disproportionately. Hard assets, cash flow today, and pricing power become valuable. Silver is both the catalyst and the signal for this shift, not because it replaces technology, but because it exposes technology's dependencies. This is why dismissing silver as just another commodity is a mistake. Silver is a systems diagnostic. It reveals where assumptions fail. It shows where financial abstraction collides with physical reality. And once that collision becomes visible, markets cannot unsee it. In the next part, we will examine how paper-silver markets masked this reality for years, how derivatives, futures, and inventory accounting delayed recognition, and why that delay makes the eventual adjustment sharper, not smoother. Because scarcity delayed is scarcity multiplied. For years, the silver market appeared calm, not because the system was balanced, but because imbalance was being absorbed elsewhere. Quietly, technically, out of sight. To understand why today's move feels so abrupt, you need to understand the role paper markets played in delaying reality. Modern commodity prices are not set primarily by physical exchange. They are set by derivatives, futures contracts, options, swaps, synthetic exposure layered on top of actual material. In theory, these instruments exist to hedge risk. In practice, they do something else. They create the illusion of abundance. When paper claims vastly exceed physical supply, price no longer reflects scarcity. It reflects confidence that scarcity will not be tested. Silver lived inside this illusion for decades. At any given moment, claims on silver, through futures and unallocated accounts, exceeded available physical metal by multiples. This worked as long as most participants treated silver as a financial exposure, not a deliverable asset. They rolled contracts, they settled in cash, they trusted the system. But this structure contains a flaw. If too many participants demand delivery simultaneously, the illusion collapses. Because paper silver cannot be melted, shipped, or installed into a solar panel, only physical silver can do that. For years, large inventories acted as buffers. Government stockpiles were drawn down. Exchange warehouses supplied deliveries. Leases filled gaps. Each action postponed recognition. But each also depleted the margin of safety. The system was not solving scarcity. It was consuming it. This is why the current situation is so dangerous. Physical inventories are thin. Industrial demand is non-negotiable. Paper markets remain vast. The leverage between claims and reality has become extreme. When leverage unwinds, repricing is not gentle. It is discontinuous. This is why silver does not behave like most commodities during stress. Oil can be substituted. Grains can be rationed. Copper can be redesigned around. Silver sits at an uncomfortable intersection. It is essential, yet marginal in cost, until it suddenly isn't. It is used in quantities small enough to ignore, until multiplied across billions of units. This makes its scarcity invisible until it becomes acute. Now consider the psychology of markets built on abstraction. When prices rise slowly, participants rationalize. When prices gap, they panic. The recent surge in silver is not being driven by retail enthusiasm. It is being driven by industrial hedging and institutional repositioning. Manufacturers locking in supply. Funds reducing exposure to long-duration risk. Governments reassessing strategic materials. These are not speculative behaviors. They are defensive ones. And defense is contagious. Once large players shift posture, liquidity evaporates. Markets that looked deep suddenly feel thin. This is how price acceleration feeds on itself. Now zoom out. This silver shock is not isolated. It intersects with broader structural stresses. Energy transition policies increased silver demand faster than supply could respond. Geopolitical fragmentation reduced trust in global supply chains. Years of underinvestment in mining constrained output. Each factor alone was manageable. Together, they created fragility. This is the hallmark of modern crises. Not a single failure, but a convergence. And convergence breaks models. This is why conventional forecasts failed. They extrapolated trends without accounting for thresholds. Physical systems have thresholds. Once crossed, behavior changes. Markets are discovering that silver crossed one. This brings us to an uncomfortable comparison. In 2008, financial markets discovered that mortgage risk had been mispriced. Paper claims exceeded underlying quality. Confidence collapsed when delivery, in the form of repayment, was demanded. Silver today is not a credit instrument, but the structure rhymes. Paper claims exceed physical availability. Confidence substitutes for verification. Leverage masks fragility. When confidence erodes, delivery matters, and delivery reveals limits. This is why the implications extend far beyond metals. If silver, a relatively small market, can expose the limits of abstraction, what does that imply for larger systems built on similar assumptions? Equity valuations, debt markets, currency confidence, all rely on the belief that constraints can be managed. Silver suggests some constraints cannot be managed, only confronted. This does not mean collapse is imminent. It means repricing is unavoidable. And repricing always begins at the margins. Small markets move first. Ignored assets speak loudest. Physical reality asserts itself quietly, then all at once. This is the stage we are entering now. The stage where investors stop asking, "Is this temporary?" and start asking, "What assumptions no longer hold?" That shift changes everything. It changes portfolio construction. It changes policy tolerance. It changes political narratives. And it changes how people interpret risk. In the final part, we will bring this entire picture together. We will examine how governments respond when physical limits collide with financial promises, why markets misinterpret those responses, and how intelligent observers distinguish between volatility and structural change. Because the real danger is not price movement. It is misunderstanding what the movement means. When physical limits collide with financial promises, governments do what they have always done. They buy time. Not because time solves the problem, but because time delays its consequences. This is the final and most misunderstood phase of systemic stress. Markets often expect decisive resolution, clear winners, clear losers, clear policy pivots. What they receive instead is ambiguity. Because ambiguity preserves confidence longer than honesty ever could. When silver exposes a real constraint, policymakers do not announce limits. They soften language. They emphasize innovation. They highlight substitution, recycling, and future supply. All of these may help. Eventually is not a strategy when demand is immediate and leverage is high. This is the moment where financial abstraction reaches its boundary. Money can be created instantly. Confidence can be managed rhetorically. But atoms move slowly. Mining projects take years. Permits take longer. Refining capacity cannot be conjured. This mismatch between financial speed and physical inertia is where modern systems struggle most. Markets sense it instinctively.
That is why volatility increases before policy clarity appears. Not because markets are irrational, but because they are probing for limits. Each spike tests resolve. Each pullback tests reassurance. Each headline tests narrative control. But beneath this noise, the direction is already set. Systems built on assumption must eventually confront reality. Silver's message is not that technology will fail. It is that technology is no longer insulated from material constraint. For decades, innovation floated above physics, supported by cheap inputs and globalized supply chains. That era is ending. Not dramatically, incrementally, unevenly, but irreversibly. This does not mean the future is bleak. It means it will be different. Capital will price resilience over speed, redundancy over efficiency, access over abstraction. Equity markets will reflect this shift. High-growth valuations dependent on flawless execution will compress. Companies with pricing power and control over inputs will outperform. Narratives of infinite scalability will lose credibility. This is not a crash thesis. It is a repricing thesis. And repricing is more dangerous than collapse because it feels manageable until it isn't. Now consider the psychological dimension. Investors have been trained for decades to expect rescue. When markets wobble, intervention follows. When stress rises, liquidity appears. This conditioning works until it encounters something liquidity cannot fix. Silver is one of those things. You cannot QE conductivity. You cannot stimulus supply chains into existence overnight. You cannot forward guidance geology. This is why silver is so uncomfortable for policymakers. It doesn't attack markets directly. It undermines assumptions quietly. And quiet undermining is the hardest to counter. This is also why silver's rise does not feel euphoric. There is no celebration, only unease. Because deep down, markets recognize that this is not about price. It is about priority. Which sectors receive scarce resources? Which projects get delayed? Which promises are quietly revised? Scarcity forces choice. Choice reveals power. And power is always political. This is where government limits become visible, not in failure, but in trade-offs. Support one industry, starve another. Subsidize one technology, delay another. Protect consumers, pressure producers. Every choice has consequences, and markets will reprice those consequences relentlessly. This is why volatility will not disappear quickly. It will migrate from metals to equities, from equities to credit, from credit to currencies, not as panic, but as adjustment. The greatest mistake investors make in moments like this is expecting clarity. Clarity comes last. First comes confusion. Then comes narrative competition. Then comes selective recognition. Only later comes consensus. By the time consensus arrives, prices have already moved. This is why understanding structure matters more than timing. You do not need to predict every fluctuation. You need to understand which assumptions are breaking,
and which remain intact. Silver tells us one assumption is no longer safe, that the modern economy can expand without friction. Friction has returned. Not everywhere, not equally, but decisively. And friction changes behavior. Companies hedge differently. Governments prioritize differently. Investors allocate differently. This does not signal the end of growth. It signals the end of effortless growth, the kind fueled by cheap inputs, limitless leverage, and global arbitrage. The next phase rewards those who understand constraints, who respect physical reality, who differentiate between financial possibility and material feasibility. This is not a call to fear. It is a call to sophistication. The world is not running out of progress. It is running into boundaries. Boundaries force intelligence. If you've stayed with this analysis to the end, it's because you sense that this story was not really about silver. Silver was simply the messenger. The message is about limits, and what happens when systems built on abstraction encounter them. That understanding alone does not make decisions for you, but it changes how you interpret everything that follows. It turns noise into signal, volatility into information, confusion into context. And in a market environment where most participants are conditioned to react emotionally, context is an edge. If this perspective helped you see the structure beneath the headlines, not with panic, not with hype, but with clarity, then engaging with this work thoughtfully helps more than you might think. A subscription supports deep, long-form analysis in an age of compression. A like tells the algorithm that intelligence still matters. And if there is one person you trust enough to think with, not argue with, not impress, but genuinely reflect with, sending them this video might start a conversation worth having. If you choose to leave a comment, let it be one that adds to understanding. A question, a challenge, a considered reflection. Those are the signals that endure. Thank you for staying until the end.